Hi, I'm Stacey West from Fund Caliber, and today we're joined by Eric Papesh, U.S. Equity Investment Specialist at Rowe Price. Thanks for joining us today, Eric.
Absolutely. Thanks, Stacey, for having me.
Now, U.S. equities have had a bit of a rough start. They've actually had their worst start of the year period since 1939, and the U.S. stock market went into bear territory in June. So maybe just give us a little bit of a background overview. Why have markets performed so badly?
Yeah, you're right. It has been a very, very difficult start to the year for U.S. equity markets and really equities globally. And I think in many respects, you can think of the recent environment as somewhat of a hangover of some of the stimulus that we saw, right, both in terms of monetary support and fiscal stimulus. And that is effectively fading right now. So, the stimulus led to pretty rapid increases in inflationary pressures, right? And in response to inflation, central banks, the U.S. Fed specifically, is trying to reduce aggregate demand to deal with inflationary pressures. So raising rates. That is leading to concerns over slowing growth. So I think, between inflation rates and questions or concerns around slowing growth, those are all, related topics. They're very kind of influential on, right, the next leg of equity markets. And I think, those three things are really at the heart of some of the weaker results we've seen so far this year from U.S. equities.
And as you said, inflation is not a U.S. issue. We're seeing it globally. But in the U.S. in particular, do you think that this kind of performance or this market has bottomed now, or do you actually think there's worse yet to come?
Yeah, it's you can think about it in terms of time, right? Kind of the duration of the correction that we've seen, or price, right? Kind of the magnitude of the recent sell-off. In terms of price, we're getting close to a level that has been kind of in line with historical corrections or recessions, right? Kind of 20 to 25% has been kind of the median correction that we've seen in economic recessions in the U.S. since the World War II period. So, I think markets year to date are down in the range of 20-ish%. So from a price standpoint, we're kind of in line with what the median returns have been. From a time standpoint, it seems like we're still a little early in this in terms of where we're at on some of those issues I mentioned a moment ago, rates, inflation, and growth. So, from a timing or a duration standpoint, it seems like we've probably got a little ways to go. Having said that, though, I do think that a lot of concerns or questions are reflected in current valuations, right? So the market's down meaningfully year to date. From the beginning of the year, the estimates, right, earnings estimates have actually increased, right? Next 12 months estimates have actually increased by about 7 to 8%. So earnings have not been kind of, right, the thing that has been driving the weakness in the equity markets. It's been kind of the price investors are willing to pay for that stream of earnings. So, the price to earnings multiple on the market has come down meaningfully, kind of 22 times forward earnings at the beginning of the year to about 16 times forward earnings today. So, I'd argue that a lot of the questions or concerns are more reflected in the price of the market today.
And you touched on it a bit there, but we are getting these mixed messages about the U.S. economy, either being, is it strong? Are we about to go into a recession? So what is your view on that? Do you see the U.S. economy going into a recession or rebounding quite strongly?
Yeah. So, here at T. Rowe, we don't have one view. We don't have a house view on kind of the direction of the market or the economy. And to be honest, there are a number of investors with differing views on this question specifically. So I'll offer my own perspective. I think we are fairly early in terms of addressing inflationary pressures. Right, the real rates in the U.S. Are still deeply negative. Inflation is still meaningfully higher than the Fed wants to see it. So I think they will continue to kind of tighten financial conditions just in aggregate to deal with inflation. And I think that is going to continue to put, pressure on the economy. That is ultimately their goal, is to slow the economy down, right? And the challenge that they've got is to kind of arrive at this, this soft landing that everybody kind of talks about. It's a difficult goal. I think it's a difficult task to execute on or to deliver on. So there is certainly a reasonably high probability that we will see kind of a contracting economy, right? So a recessionary environment. I think it's not kind of a binary, will we see a recession or not? But I also think you need to factor in kind of the depth of any recession, right? So again, I think it's a reasonably high probability that we will experience declining economic growth. But I think the duration of any decline is likely to be pretty modest, and that's in part due to the fact that the average corporate entity in the States is in a really pretty healthy position in terms of just their underlying balance sheets, right? Similarly, I think the broad kind of consumer in the U.S. is in a pretty healthy position as well. So strong balance sheets on the corporate side and on the consumer side, I think would probably minimize, right, the depth of any impending recession if in fact we see one.
And again, appreciate this. This might not necessarily be a house view, but for you, do you think that the large cap space, or maybe even smaller companies in the US, potentially even mid caps, maybe to an extent, are offering better value for investors, given everything that we've just talked about being so up in the air and unpredictable? Do you have any thoughts on, kind of where you think the better opportunity might be at the minute?
Yeah, absolutely. So I think within the U.S. equity market today, the small and mid cap segment is very attractive currently, and there's a few points I'll offer there. So I think having a kind of a dedicated exposure to the smaller end of the U.S. equity market is a very kind of prudent strategy, right? Very, very exciting companies, down cap, smaller cap companies. A lot of growth and innovation takes place just generally in the smaller end of the market. The ability of active managers to add value, add alpha there, I think is very exciting and interesting as well. Currently, the valuations of kind of smaller companies compared to large cap companies in the U.S. are very, very attractive. So if you look back historically from kind of similar starting points in terms of valuations, you've tended to see meaningful outperformance from small cap over kind of 6-12 months following levels where we're at today. So there's a strong valuation argument in favor of small cap today. I think the recent kind of reports that we've seen from small cap companies have tended to be better than for their large cap competitors as well. And kind of the revisions, right? So the most recent updates in terms of analysts publishing updates to their estimates have actually been better. So strong results recently, and kind of things have generally been improving for the average small cap company at a faster rate than they have for large cap companies. The other thing I'll highlight too is just if you look back historically from kind of market lows or from recessions, small cap companies on average have really done well coming out of the downturn effectively. So I think, again, going back to my initial comment, I think it's a very good place to have a dedicated exposure to, and I think kind of the tactical setup currently is kind of more attractive than normal. So I would certainly encourage investors to have some allocation to the smaller end of the market today.
That's very interesting. And then just lastly, so the U.S. equity market has led world stock markets over the past decade. Do you think that time has come to an end and other markets will do better going forward?
Yeah, it's a good question. I wish I had a crystal ball, right, that I could tell you with a lot of confidence. I mean, you're right. The U.S. equity market has really delivered exceptional results over the last decade. I think that the 3-year number is kind of plus 25% annually. So exceptionally strong results recently. We've seen a little bit of a give back in terms of leadership so far this year. I think markets outside the United States have delivered a little bit better performance compared to the U.S. equity market. 3 to 4%, I think, year to date. So not heroic, but on kind of the right side of the ledger, effectively. I think the profitability within the U.S. equity market, is a big reason that the market has delivered the returns that it has. Right, the profitability metrics are at a much higher level in the U.S. versus markets outside the U.S. And at the same time, the growth that has been delivered has been meaningfully better as well. So if you think about higher levels of profitability and rapid growth, you would kind of expect to see better performance, from those types of companies on average. But again, the more recent period has been a little bit in favor of markets outside the U.S.
Well, Eric, thank you very much for your time today and sharing your views. We really appreciate it.
Thanks for having me, Stacey.
To learn more about T. Rowe Price funds that are elite rated by Fund Caliber, including the T. Rowe Price U.S. Large Cap Growth Equity and T. Rowe Price U.S. Smaller Companies Equity, please visit our website, fundcaliber.com. And don't forget to like and subscribe for weekly videos.